Hey, fellow investors, have you ever wondered why some of your investment decisions don't pan out as expected, even when you think you've done your homework? Well, you're not alone. The truth is, our minds can play tricks on us when it comes to investing, leading us down paths that might not be in our best interest. Today, we're going to explore 6 psychological traps that can seriously mess with your investment game. By understanding these traps, you'll be better equipped to make smarter, more rational decisions with your money. Let's kick things off with confirmation bias. You know that feeling when you're so sure about an investment that you only look for information that supports your view? That's confirmation bias in action. I remember when I first started investing, I was convinced that a certain tech stock was going to skyrocket. I spent hours reading articles that agreed with my opinion, completely ignoring any negative news. Needless to say, it didn't end well. To avoid this trap, make it a habit to actively seek out opposing viewpoints. It might feel uncomfortable at first, but it'll give you a more balanced perspective. Next up is loss aversion. This is a big one that I see trip up even experienced investors. We humans hate losing more than we love winning. It's why we often hold on to losing investments, hoping they'll bounce back instead of cutting our losses and moving on. I've been guilty of this myself, watching a stock continue to plummet because I couldn't bear to sell at a loss. The key here is to set clear exit strategies before you invest. Decide in advance at what point you'll sell if things go south. It takes the emotion out of the decision when the time comes. Now let's talk about herd mentality. It's tempting to follow the crowd, especially when everyone seems to be making money on the latest hot stock or cryptocurrency. But remember, just because everyone's doing it doesn't mean it's the right move for you. I've seen friends jump into investments simply because they were afraid of missing out, without doing any research of their own. Instead of following the herd, focus on your own financial goals and risk tolerance. Do your own analysis and make decisions based on your unique situation. Overconfidence bias is another sneaky trap. It's easy to think we're smarter than the average investor, especially after a few successful trades. But here's the thing, the market is unpredictable, and no one can consistently outsmart it. I learned this lesson the hard way when I thought I had figured out a foolproof trading strategy. Spoiler alert, it wasn't foolproof. Stay humble, diversify your portfolio, and remember that even the pros get it wrong sometimes. Anchoring bias is when we fixate on a specific piece of information when making decisions. In investing, this often means focusing too much on the past price of a stock. Just because a stock used to trade at $100 doesn't mean it's a bargain at $50. The key is to focus on the company's fundamentals and future prospects, not just its price history. I try to approach each investment decision with fresh eyes, looking at current data rather than getting hung up on past performance. Last but not least, we have recency bias. This is our tendency to give more weight to recent events when making decisions. In the investing world, it can lead us to think that current market trends will continue indefinitely. For example, during a bull market, it's easy to forget that downturns are a normal part of the cycle. I've caught myself getting overly optimistic during good times and too pessimistic during market dips. The antidote? Take a step back and look at long-term trends. Remember that markets are cyclical, and what goes up must eventually come down, and vice versa. So, how do we put all this into practice? First, awareness is key. Simply knowing these biases exist can help you catch yourself when you're falling into one of these traps. Second, develop a systematic approach to investing. Create a well-thought-out investment plan and stick to it, regardless of short-term market noise. Third, consider working with a financial advisor who can provide an objective perspective and help keep your biases in check. Remember, investing is as much about managing your emotions as it is about managing your money. By recognizing and overcoming these psychological traps, you'll be well on your way to making more rational, successful investment decisions. That's all for today, fellow investors. If you found this information helpful, don't forget to like, share, and subscribe to our channel for more investing insights. And hey, drop a comment below sharing which of these psychological traps you've encountered in your own investing journey. Until next time, happy investing.